Assalamualaikum Dr. Muhammad Hafiz bin Ali and fellow classmates. We are group from NBI 2A and today we are excited to present our finding of financial report. Before we begin, I'd like to introduce my team member. First, we have Ahmad Haikal Zamani bin Ahmad Azmi. Next is Ammar Sufi. Then we have Muhammad Amirul Irfan. And lastly, Nur Rashidah Ilyana. I am Ahmad Haikal Zamani bin Ahmad Azmi and I be starting use of which the introduction. Let's dive in. Today I be presenting a financial performance analysis of two FMCG giant in Malaysia. First, Dash Lady Milk Industry Berhad and second, Nestle Malaysia Berhad. Using financial statement search from Bursa Malaysia, this report aims to achieve three key objectives. First, to assess the overall financial health of both of company. Second, to evaluate critical ratios, specifically liquidity, profitability, and solvency. And finally, the third to identify trend and pattern over time to understand how effectively this company manage their growth and stability. By the end of the analysis, we'll break the gap between financial management theory and the real-world corporate decision making. So, let's look at our first subject. Dash Radio Malaysia, established in 1963 in Petaling Jaya. Dash Radio has spent over 60 years nourishing and the nation, which a dedicated team of over 600 staff. They produce everything from family powder to yogurt and UHT milk. Operating within a global dairy network, they balance international excellence with a deep local presence. Their mission is nourishing our planet and people at various stages of life. Is currently reaching a new milestone, which their recent transition to the state-of-the-art estate facility, ensuring they remain a leader in Malaysia dairy sector for generations to come. Turning to our second subject, Nestle Malaysia Sdn Bhd. As part of the world's largest food and beverage corporation, Nestle Malaysia journey began way back in 1912 in Penang. Today, it's a powerhouse with 6 factories and over 5,000 employees. Nestle is a household name producing over 500 halal certificate products, including iconic brands like Milo, Maggi, and Nestle. Their focus goes beyond just food. They are global leader in nutrition, health, and wellness. Their core purpose harnessing the power of food to enhance quality of life to everyone, today and for the future.
Assalamualaikum and hello, my name is Ammar Sufi and my message number is 2025911725. Today I will be presenting a comparative financial analysis of two major players in the consumer goods sector, Dash Lady Milk Industry Berhad and Nestle Malaysia Berhad. Our analysis covers the financial trends from 2020 to 2024, focusing on their distinct strategies regarding liquidity, leverage, and operational efficiency and profitability. Let's begin by looking at liquidity. This measures each company's ability to meet short-term obligations. When we look at the current ratio, we see two very different strategies in 2024. Dash Lady maintained a ratio of 0.84, reflecting a conservative approach with a higher cash balance of RM32.4 million. In contrast, Nestle operates with a current ratio of 0.55, running a significant working capital deficit of RM1.09 billion. This indicates that Nestle relies heavily on supplier credit to maximize its demand cash flow rather than holding large cash reserves. We see a similar trend in the quick ratio, which excludes inventory. Dash Lady stood at 0.40, maintaining a stable position with liquid assets. Nestle, however, was at a more critical level of 0.20, suggesting its extreme reliance on fast daily cash ground to cover its liabilities. Moving on to leverage, which assess financial risk. The debt ratio for 2024 highlight Nestle's aggressive use of external financial. Nestle total liabilities reached 84% of its assets. A massive burden of RM2.54 billion. Conservatively, Dutch Lady remained conservative with liability making up only 46% of its assets. This difference shows Nestle maximized equity returns through debt, while Dutch Lady has reduced commitment following the completion of its new factory investment regarding interest coverage of time interest earned (TIE). Dutch Lady is in a safer position. It covers its interest cost 26.6 times over, whereas Nestle, despite higher profits, face a much higher interest burden, covering it 15.8 times. This made Dutch Lady relatively safer from the risk of interest default. Next, we examine operating efficiency. This is when Nestle demonstrates its market dominance. In terms of inventory turnover, Nestle is highly efficient, turning its stock over 5.7 times a year compared to Dutch Lady 4.65 times. Even though Nestle holds significantly more inventory, their supply chains convert goods into sales much faster than Dutch Lady. Similarly, for the average collection period, Nestle is faster collecting debt. It takes Nestle as average of 27 days to collect from customer compared to 34 days for Dutch Lady. This could prove the strength of Nestle credit position and its efficient collection system in the market. Let's discuss profitability. Looking at return of assets, Nestle leads with 11.5% versus Dutch Lady 9.6%. This indicates Nestle's superior ability to optimize every ringgit of assets of generate returns. The contrast is even sharper in return of equity. Nestle achieved a staggering return for shareholders, while Dutch Lady record 20.9%. Nestle achieved this through its high leverage structure, providing extreme value returns to investors despite a small equity base. However, when we look at net profit margin, the gap closed into 2024. Dutch Lady managed to increase its margin to 6.7%. Meanwhile, Nestle experienced a contraction due to rising commodity costs and lower domestic sales, bringing their margin down significantly to match Dutch Lady at roughly 6.7% based on the narratives analysis.
Hi, Assalamualaikum. My name is Muhammad Amirul Irfan bin Muhammad Azizul. My matrix number is 2025113077. I will be explaining on the comparison ratio between Dutch Lady Milk Industries Berhad and Nestle Malaysia Berhad. Let's start with liquidity ratio, which shows the company's ability to pay its bill on time. Dutch Lady is the clear leader here because their current ratio is 1.58 times, more than double Nestle's, which is 0.70 times. Furthermore, Dutch Lady's quick ratio of 0.60 times show they are not overly reliant on selling of inventory to stay afloat. Simply put, Dutch Lady has built a significant cash cushion while Nestle operates on much thinner margins of safety. Next, we go to leverage ratio. When we look at how this company finance their operations, the contrast is stark. Dutch Lady follows a very conservative path with a debt ratio of only 45%. Compare that to Nestle, whose debt sits at a heavy 80.5%. Perhaps the most impressive number for Dutch Lady is their time interest earned, which is 58 times. This means they earn $58 for every dollar they own in interest. They are not just safe, instead, they are fortress level secure. Nestle, at 17 times, is healthy but far more aggressive in its use of debt. However, the narrative shifts when we talk about operational efficiency. This is where Nestle shines. Nestle turns over its inventory 6.2 times a year, compared to Dutch Lady 4.9 times a year. Furthermore, Nestle collects its debts in just 27 days, a full week faster than Dutch Lady, which is 34 days. Nestle is a high-speed machine because they can produce, they sell, and collect cash faster, which keeps their working capital constantly moving. For last, let's look at the returns, which is profitability ratio. Dutch Lady is more efficient at the micro level because their return on assets is 41.3% and net profit margin is 21.9%, are nearly double Nestle's. This tells us that Dutch Lady has excellent cost control and get more profit from their equipment and factories. However, if you are a shareholder, you might look at Nestle returns on equity of 105%. While this high ROE is partly driven by their high debt, it represents a massive return for those who invested in the company.
Hi, my name is Norshida Ilyana and my metric number is 2025791431. Now I will share my recommendation and the conclusion based on the financial performance of Dutch Lady Milks industry, Berhad and Nestle Malaysia for the year 2024. Starting with Nestle Malaysia, the companies continue to show strong performance and stability. In 2024, it's recorded around RM 6.2 billion in revenue and RM 460 million in net strong profits, supported by strong sales across beverages, culinary, and nutrition products. It consistent growth, solid cash flow, and high dividend payout of 179% per share show that it is financially resilient and rewards shareholders regularly. Because of its large size and diversified product range, Nestle Malaysia can handle market changes and shift in consumer demand better than smaller players. So, for investors looking for stable, low-risk investment with a steady returns, Nestle is a very solid option. On the other hand, Dutch Lady has shown impressive growth over the past year. Even though it operates on smaller scales, its revenue increased to RM 1.45 billion and net worth rose to RM 96.6 million, which about an increased 80% increase compared to 2023. This growth is mainly due to new Banda Estates manufacturing facility, which improved efficiencies and reduced costs. Dutch Lady also recorded a strong return on equity of 90%, show that it's effectively using shareholders' funds to generate profits. The company shows on products innovations, nutrition, and sustainability align with the health-conscious trend among consumers. With its strong brand and loyal customer base in Malaysia, Dutch Lady has great potential to grow in further in the coming years. So, for investor, the choice depends on their priorities. Nestle Malaysia is ideal for those seeking stable, consistent earning and long-term security, while Dutch Lady is more suitable for growth-oriented investors who are willingly to take moderate risks to achieve their capital appreciation in the future. In summary, Nestle Malaysia represents stability and independent income, and Dutch Lady represent a growth company with a strong product prospects. Investors can choose based on whether they prefer safety and dividends or growth opportunities in the Malaysian dairy market.